It gives me pleasure to introduce my guest. We've got Mr. D.P. Singh, who is the Executive Director at SBI Mutual Fund, joining in. Thank you so much, Mr. Singh, for joining this program and for taking the time. You yourself have seen several market cycles. What, according to you, is the best strategy that a retail investor should follow? Should it be that they have a broad asset allocation and that they should rebalance on a regular basis so that they're not overexposed on either one end?
Thank you, Alex. First of all, let me thank you for having me on the show. About your question, I will say yes. I've been in the industry for more than 20 years now, and we have seen several cycles. But what I feel that retail investors, whenever they behave in an irrational manner in the sense that they get very fearful or they get very greedy, that is it. That is what doesn't give them the right kind of returns. So the first and the best thing is every investor. It could be a retail investor, it could be HNI investor, it could be ultra HNI investor. Everybody has to have an asset allocation is a must. That is number one. And then over and above that, you have to have your core portfolio and your satellite portfolio. Core and satellite portfolio, when I say it means for a layman, that something which you need, that it should continue to grow, but you can need this money at any point of time, very uncertain. You may need it tomorrow, you may need it after 1 month, you may need it in the next 3 months, and you may not need it in the next 2 years. That person, that the asset allocation of that is a different ball game, and the asset allocation for your another part, that is satellite portfolio, that is surplus money over and above the core portfolio. Their but overall asset allocation has to be there. Whether you want to see it in one bucket or whether you want to see it in 2 buckets, that is very necessary. Yeah, Alex.
Absolutely, and that's a very fair point. In fact, to your point on the core and satellite portfolio, I think even within that, a lot of advisors say that even within your equity portion, you should have a core and satellite, and even your debt, you should have a core and satellite. But having said that, Mr. Singh, there are now products out there, there are mutual fund schemes that offer you a little bit of both, and they allow you a lot of flexibility. So there is the Balanced Advantage Fund that is now available, that has a dynamic asset allocation between equity and debt, and you don't necessarily have to time the market. I think that is the key point. You have an NFO open right now. Could you take us through the main salient features of this fund?
Yeah, sure. See, this Balanced Advantage category per se is something which is taking away the hassles of investors from their shoulders to the shoulders of the fund managers or the experts to call for the first time. Because what is happening, if I am having a core and satellite portfolio and equity and debt both, every time I feel that equity is hotted up, let me come out of it, let me put more in debt, let me take out of debt, let me put it in equity. Every time I do it, one, it's a hassle. Second, every time I do that, the tax liability triggers. As you are aware that in the capital markets, the mutual fund are securities, and the tax liability will trigger only at the time of encashment or redemption, what you call it. So if your fund manager is doing it within the fund, then no such thing triggers, no tax liability triggers. That is one part which is over and above the return. And second, taking a knowledge-based, skill-based call on your portfolio for an individual is definitely a difficult job, because if I have surplus money, I'm working somewhere, my core area is to do in that particular job or do in that particular business. This handling securities and handling equities and that is not my core area. For that thing, you have to depend upon somebody without paying any extra fee, without paying any extra charges. The fund managers will take a call. What is the time now? Now, for example, today, this is unanimity that the market is costly. The equity market is costly. Yes, it is costly. But is there any opportunity within that costly market? The answer is absolutely yes. There are so many companies at this point of time also which can give you very good return. But at the same time, will you be putting 100% of your money into equities at that point of time? The answer is no. Then what percentage, on what basis, what is to be done? For an individual, it's very, very difficult. So fund managers will take a call, and this NFO, which we have launched, we have created an asset allocation committee within the company. The so-called fund managers have to take a call on a monthly basis or fortnightly basis. How much money has to be in debt, how much money has to be in equity, and in what proportion it has to be done that the tax liability at the time of redemption is that of equity only as per the tax laws today. Tax laws are always dynamic. Today, the tax laws say that if you are more than 65% equity, then it will be equity taxation. Tomorrow, it could be 75 or 55 or 51, whatever. So in this fund, which is dynamically managed fund, we will be managing the portfolio in such a manner that the investor continue to enjoy the preferred tax treatment when at the time of his withdrawal. That is one major part of it. And second is that yes, we have created a sentiment index itself in the fund itself, where we'll be looking at the sentiment. When the sentiment is very, very bullish, we'll become very cautious. We'll reduce the equity. And when the sentiment is bad and the valuations are good, we'll increase the equity portion. So that will be a reset on monthly intervals. That's what is inbuilt in the fund itself.
So I want to touch a little bit more on these 2 points that you've raised, because it's really intriguing. And specifically, I would think, Mr. Singh, this is for an investor who doesn't want to take the headache of looking at the markets on an ongoing basis. Is there a crack today? What is happening in the US Fed? Is there a taper tantrum that is going to worry the rest of the financial markets across the globe? So that is one thing. But I'm intrigued about this committee that you say is going to identify at what point the asset allocation should be. It's a collective decision that takes place. It's not just the fund manager.
Yeah, it's a collective decision. There's a permanent asset allocation committee of the fund house, which will see what should be the proper allocation of a core and satellite portfolio. And for that particular fund, then they will take a call what percentages will change. That will be taken within the committee, and fund manager will have an argument to make, because ultimately, see, all these things are to the best effort basis. See, if market is going down in a much bigger way because the cycles are very slow, one thing we have to keep in mind: the fortune of the fund will depend upon the fortune of the market. Within that, you have to efficiently manage it, that when it's falling, you fall less. When it goes up, you get better returns for the investor. That is something which fund managers do. But one thing is very clear from an individual's point of view. If I'm a layman, I have a particular job or a particular trade or particular workspace, then fund manager will definitely be able to take a much better call on my money than I can take on myself. So that's a collective investment scheme's basic philosophy, that I will take a call on when we are having 1 million customers. The call has to be taken on behalf of 1 million people, right? So then it has to be very, very justified, very well thought of call on the fund, because it is going to impact each and every investor.
Yes. Mr. Singh, one big advantage that you already alluded to, and this is the second point that I wanted to touch on, is the tax aspect. And you made a very valid point. It's a point to note that if an individual is doing the rebalancing of his portfolio, his or her portfolio by themselves, then they would necessarily have to book out and have capital gains on equity or debt, whichever way. How does the tax liability work for this balanced advantage fund?
So that's what we, as per the approval taken from SEBI, this is a dynamic asset allocation fund, and we can go to 0 to 100% in either class. But again, the tax law, this is not, we are launching today, but this fund is going to be there for decades and centuries to come. So tax laws will keep on changing every year. So we will have the ability to change the contours of the fund as per the tax laws. Today's tax law says 65% has to be in equity category, and 35 more than that, you have to be minimum in 65% equity category. Within equity category, now my model is saying today I will put 30% into equities. So remaining 35% will put into arbitrage fund, which comes into the equity category. We'll put it in the arbitrage, and it will make it 65%. That 35% is absolutely, it's not affected with the volatility in the market. It's going to be equivalent to or little less, little more than the policy rate at that point of time. And remaining 35% is in debt. So we'll manage in such a manner that if somebody withdraws today, he will have the benefit of less than 1 year 15%, more than 1 year 10%. These are the tax rates today. And we are fortunate to have very, very favorable tax rate as far as capital gains is concerned. And because government also wants that this country has to be the country of investors, not of savers. We have to move from savers to investors. That suits everybody, because that will trigger our entrepreneurial spirit as well. So that's the basic question, and we will take care. The fund house will take care that the investor, when it withdraws, when gets the best preferred tax treatment at the time of withdrawal.
Mr. Singh, my last question to you. Your fund house has a wide array of offerings, both on the debt side as well as on the equity side. Having said that, when you talk about the Balanced Advantage Fund, and you mentioned core and satellite also, in your opinion, and of course every investor has to take this decision for themselves, possibly with consultation from their financial expert and advisor, but in your estimation, how does one plan the Balanced Advantage Fund as a part of the overall portfolio?
See, first thing first, the penetration of mutual funds in our country is very, very low. We are just 12% of the GDP as the AUM of the country, whereas the normal rate in all the developing countries is more than 60-67%. In developed countries, more than 100%. So these funds are very good for the beginners or less evolved, the people who are coming into the markets now. When today the interest rates are so low that it doesn't attract anything, because today if the fixed deposit rate of banks or any fixed coupon instrument is 5.5-6%, which is all taxable, the post-tax return in your hand is around 3.75-4%, which is not meeting even the inflation rate. So you own your income, you have to put it. So everybody wants that he should have a kicker, he or she should have a kicker, something at least real return should come. The probability of getting a positive return or near double-digit return or higher single-digit return are very much there, and the probability is very high, because the general golden rule is that the capital markets should give inflation plus growth kind of return over a medium to longer period. So today, if our inflation is say 5%, growth rate is 6-7%, on an average, 1%, 2% plus minus, the market should give 12-13% or 10-11% return over a medium to longer period. So that's why we are saying, if you are coming into a fund which is having equity portion, the minimum holding period should be 3 to 5 years. Because in the short run, one can have a very good return, which can be taken as a bonus. And if it is a little volatile, one should not worry about it. So that's what the basic, and this has been the golden rule for ages, and that continues. So that will continue for the times to come as well.
All right, Mr. Singh, thank you so much for taking the time. It's a pleasure, as always, speaking to you. I look forward to speaking to you once again in the future. Wish you all the best for the offer that you currently have open as well.
Thank you very much, Alec. Thanks a lot.